This voice is taken from an article with the title, How Do I Calculate Risk-Reward Ratios in Trading?, which has been published on TRADERTALKSNET. Risk-reward ratio is one of the most important PTS in trading. It is a measure of how much you are willing to risk in order to get a certain reward. This ratio is used to help determine whether a trade is likely to be profitable or not. The risk-reward ratio is calculated by dividing the potential reward by the potential risk. For example, if you were willing to risk $100 on a trade, and the potential reward was $200, then the risk-reward ratio would be 2 to 1, 200 divided by 100 equals 2. This means that for every dollar risked, you could potentially make $2 in profits. When calculating the risk-reward ratio, you should always consider the size of the potential reward relative to the size of the potential risk. If the potential reward is much larger than the potential risk, then the risk-reward ratio will be high. This means that the trade is more likely to be profitable. On the other hand, if the potential reward is much smaller than the potential risk, then the risk-reward ratio will be low. This means that the trade is less likely to be profitable. It is important to remember that the risk-reward ratio is only one part of the puzzle when it comes to trading. You also need to consider other factors such as the probability of the trade being profitable, the size of the stop loss, and the time frame of the trade. In order to calculate the risk-reward ratio, you need to decide how much you are willing to risk on the trade. This is typically done by setting a stop loss at a certain price point. The risk is then calculated by subtracting the entry price from the stop loss. For example, if you enter the trade at $1.00 and set a stop loss at 90 cents, then the risk is 10 cents. 1.00 minus 0.90 equals 0.10. Once you have determined the risk, you can then calculate the potential reward. This is typically done by setting a target price at a certain price point. The reward is then calculated by subtracting the entry price from the target price. For example, if you enter the trade at $1 and set a target price at $1.20, the reward is 20 cents. 1.20 minus 1.00 equals 0.20. Finally, you can calculate the risk-reward ratio by dividing the potential reward by the potential risk. In the previous example, the risk-reward ratio WOU LD 2 to 1, 0.20 divided by 0.10 equals 2. In conclusion, risk-reward ratio is an important concept in trading. It is used to help determine whether a trade is likely to be profitable or not. To calculate the risk-reward ratio, you need to decide how much you are willing to risk on the trade and set a target price. The risk-reward ratio is then calculated by dividing the potential reward by the potential risk.